Okay, so it's day 26. Again, the same old thing. $333 from DAI, the stable coin, over to Bitcoin. So we'll do that now. Okay, so there you have it. That's done. And this really doesn't pertain to Bitcoin, so to speak. But I was just watching this, and again, we have George Gammon speaking with regards to interest rates and mortgage, rates, and the chance that the housing market might crash because of interest rates. And again, this all kind of ties in. Well, I guess it does tie into Bitcoin because like Max Kaiser and a lot of people, as this guy would say, because the government is so used to, like, they're addicted, they're like a drug addict to printing money. They think that's the answer for anything. They want something done, they throw money at it, yada yada yada. Keep interest rates down, throw, again, print as much money as you want, keep interest rates down to nothing, yada yada yada. But you're eventually gonna have to pay the price. Like, nothing's free in this world. And you can prolong this as long as you want, or they're going to make a major catastrophe down the road. And this guy just explains it, right? And essentially, and again, this is where Bitcoin, you know, has the whole reason why it came about. And this would appear to be very bullish for interest rates, just simply because the smart money knows what's going on. They know that fiat currency is basically worth nothing. If it is going to have any sort of last, value, the only way it's going to be worth anything is if interest rates go up, right? Because if mass inflation kicks in, and it's like the old stories of needing a wheelbarrow full of money to buy a loaf of bread, then Bitcoin will definitely be worth something. And the government, as far as I'm concerned, doesn't want to see that, so they're probably going to jack up rates. That's the only thing I can see. So anyways, he kind of explains it, so I'll just roll it a bit and we can listen to it.
Forcing many businesses to go bust. We've had hundreds of thousands of small and mid-sized businesses shut their doors, and they're never coming back. So incomes go up, expenses go down. The amount of stuff, goods and services in the real economy also goes down. This leads to one thing: consumer prices going up. And the market is telling us in a variety of ways that it expects prices to move higher.
I just like to interject here. Like, think about that for a second. Okay, now I think I cut off the first part, so you didn't get to hear this. But he's saying, when he said, like, on that point A, income's going up, how he came about with that is with the stimulus checks. People have actually realized a 10% increase in their incomes, okay? And a lot of their expenses have gone down because, like, a lot of them aren't driving to work. They're not eating out at lunch when they were at work, so on and so forth. So their expenses have actually gone down. But the amount of stuff being created by the economy has gone down. So think about that. That is a pure recipe for massive inflation. Think about that. If you have more money, less expenses, but there's less stuff on the market. So it's just basic supply and demand. So if you have people with all kinds of money chasing fewer products because the economy is producing fewer products, those prices have to go up. And if you get an insane amount of inflation, they have to raise interest rates. Like, this is almost pretty much a guarantee that they have to do this. So anyways, I'll run it, and I'll interject where I see fit.
Couple charts here. Actually, before we get to this one, editor, throw up a chart of copper. Let's take a look at what it has done over the past year. It's gone straight up to a point now where it's almost at an all-time high. This is one way of the market telling us it expects consumer price inflation in the future. Let's look at this chart. 10-year Treasury. We start December 20th, go all the way to March 2021. On the left, we go from 75 basis points up to a whopping 1.5%. And I know these numbers are small, but the amount, the percentage increase has been dramatic. We started December 20 under 1%. It goes down slightly. It really went up in January of 2021, plateaued a bit, but then it's gone straight up over 1.5%. Now it's dipped down just a little, but you can see the trend line going straight up. Well, if the 10-year Treasury rate is going up, what does that do to mortgage rates?
See, and this is another thing here. Like, again, people might say like 0.75% to 1.5%. Okay, what's the big deal? It's only another 0.75%. Well, what you have to understand, like he said too, is percentage-wise, it's doubled. See, and this is the problem with low interest rates, is when you have really, really low interest rates, an increase doesn't have to increase dramatically to have a dramatic effect. Like if interest rates are 10% and interest rates go up by 1%, like goes from 10% to 11%. Okay. So it's a 1% like increase in the rate. That's only a 10% increase. But if it goes from like here, 0.75% to 1.5%, that is 100% increase. It is just doubled. And that's why it's dangerous to have very low interest rates. Like most people think, oh, low interest rates is great, money's cheap and blah, 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 blah. But it doesn't take much to affect the economy when you have low interest rates. You don't need like 2-3% increases to destroy the economy. Just like this 0.75% increase, that has had a 100% increase in interest rates from a percentage point of view. And I know maybe it's hard to understand what I'm saying, but like it doesn't take much to change the economy, because say for instance, you have a house that's $1 million, right? And you're only paying like 1.5%. If that interest rate goes from 1.5% to say like 2.5%, there's a chance you can't make that mortgage payment anymore, because that extra 1%. So think about it. So over the course of a year, if you got $1 million, right, and you increase by 1%, that equals $10,000. So divide that by 12. That means that your mortgage is going to increase by 833%. $833.33 a month, right? So this is what I'm saying. Like, it doesn't have to be that dramatic. But like I said, if you were already paying 10% interest on a house, and it goes up to 11%, that's more palatable. But when you start talking about these really low interest rates, that's why it's very dangerous, right? And if they have to increase it by 2%, now you're paying an extra $1,600 a month. That's why you have to really pay attention to interest rates. So anyways, I'll let him continue.
Let's look at another chart. Same time frame. On the left, we go from 2.64% up to 2.82%. Again, it's not a huge move in terms of the actual amount that it's gone up, but when you look at it in terms of a percentage of increase, it is definitely substantial. It starts at 2.7% in December, then pretty much tracks along this same line. We get to a point right now where we're higher, much higher than we were in December of 2020. But the main thing I want you to notice is the trend line going up here because of inflation expectations, and the trend line going up here as well on the 30-year mortgage. So if mortgage rates are going up, as most of you know, that's going to put downward pressure on home prices. So the next question becomes, how much downward pressure, and what if interest rates continue on their current trajectory, going straight up to a point where they actually normalize? Let's say go back to the rates we saw in the 1990s. Let's start by using an example, kind of the average home, I guess, $300,000. We'll put 10% down. At a 3% interest rate, assuming we have a 30-year fixed rate mortgage, the payment would be $1,533. $34. Editor, let's go ahead and throw up the mortgage calculator so the viewer can follow along with these numbers. But if interest rates went up to where they were just in the 1990s, so nothing extreme like when Paul Volcker came in and jacked rates up to 18%, and who knows what mortgage rates were back in the early 1980s, but nothing that extreme, just going back to kind of an average. That would take someone's payment for the exact same house, an apples to apples comparison, up to $2,377. So most people that can afford $1,500 probably could not afford $2,300. So let's think this through. If someone can only afford that $1,500 payment and rates go up to 8%, how much home can they afford? Well, back here at 3%, they could afford a $300,000 home. Here at 8%, they can only afford a $190,000 home. This means purchasing power across the board would go down by 36%. If demand or purchasing power goes down by 36%, what does that do to home prices? They go straight down. So the bottom line is, if the government continues to deficit spend like we have never seen before, and M2 money supply goes parabolic, that's the amount of currency units in the real economy chasing goods and services, we will see expectations for inflation continue to rise. If that happens, the 10-year goes up, mortgage rates go up, and at a certain point, that will affect affordability enough to start bringing down prices, potentially even create a housing market crash.
Okay, so yeah, you saw what he was saying there, and it was again, like,
hey Paul,
people
I'm
will
creating
say
an online course that teaches people filmmaking in just 14.
People will say, okay, so what does that have to do with Bitcoin? So again, what that has to do with Bitcoin is simply this. Again, the smart money knows what's going on. Like, okay, if you're just some person who casually looks at finance and so on and so forth, you might say, okay, Bitcoin, mortgages, it's all money, yada, yada, whatever the case may be. But you have to understand that these people know, the people that are, I'm talking about, high flyers, guys with, hundreds of millions of dollars, if not billions of dollars. They know that anything that's real estate related, they're going to dump. And I remember, I was talking to this one guy, and he was telling me, he said, like, he was right into real estate, and he said, yeah, he goes, I'm telling you, he goes, Bitcoin's going to be like a black hole. It's going to suck in everything, because, like, you have to realize, like, one thing I've learned, like, about when I was a financial advisor, was never look at other people's finances through your eyes. Okay, and what I mean by that is that what might seem good or bad or whatever to you might not pertain to somebody else. So let's say, for instance, you're just a regular person, making decent money, but you're not rich by any stretch of the imagination, right? And let's say you're giving this person advice. You might be saying, you know what, I think, this is a good investment because of this, that, and the other thing. And this person has, like I said, it's worth hundreds of millions of dollars. That, like, they're looking at you kind of strange, because they don't look at life in the sense of, like, oh, I got to pay the mortgage, or I got to pay the rent, or I got a car payment coming up, or I got to pay. All that stuff is covered with them. They're not worried about that. That doesn't even enter the equation. What does concern them is that, what about down the road? Like, am I going to be able to leave a legacy for my children, and so on and so forth? Like, and I mean, like the vast majority of this wealth that I've accumulated, can I pass this on? So when they hear things like, oh, if you're in real estate, it could go down 36%, or if I invest in something else, it could go down whatever. Like, you might think to yourself, I own a house. if it goes down 36%, I'll still live there. It's not a big deal, whatever. And maybe it's not. But you got to remember, some of these people, like when they buy skyscrapers and all this sort of stuff, they're talking about hundreds of millions of dollars, like, or billions, like I said. And their concern is like a 30% drop in their net worth is huge, right? And so they're looking at things totally different. And like I said, like if these people, like the main thing that they're concerned about, don't get me wrong, they want to make money, but they're more concerned about keeping what they already have. And if they are convinced something like Bitcoin is the only viable way to, to sustain wealth, they'll do it. And they, like, the thing is too, once they start dumping something, they will not stop. Like if it's like, there's been instances like commercial real estate, it'll just get walloped beyond belief. Like they will dump it if they think it's going down. Like there's been all kinds of like shopping malls and stuff just abandoned. They saw it, like they saw the trend lines, right? People buying stuff online, yada, yada, yada. Like whole malls, like especially in the States, they just abandoned them. They just, like, that was some conglomerate that owned that, like multi-million-dollar. They probably had 50, 100 malls throughout the States. And they look at the numbers and they're like, okay, we're not holding on to this. Just dump it. Just abandon it. Right. We'll have it torn down. We'll sell it for, you know what I mean? Whatever we can get for it. Because they're not going to stick around, and they will when they make huge moves, like you can't stop it. And so this whole thing, but what he's talking about, like these drops, and I've always said this too, people don't buy a house, they buy a payment. That's the number one thing you have to realize. People buy a payment. They don't buy a house. Exactly like he said. If you can only afford like $1,500 a month, that's gonna change the price of the house. Because if it's 3% and $1,500 a month can get you a $300,000 house, if interest rates go to 8%, you can only afford a $190,000 house. It's the exact same house, but I'm saying people buy a payment. Like if you can only afford that $1,500, that house will be worth whatever that payment can get you at that interest rate. When people say, "Oh, I live in $1 million house," is it $1 million house, or is it $1 million house based on the current rates? Because I'll tell you right now, if rates go up, if they double, I'll guarantee you that's not $1 million house anymore, right? Because it'll be based on people's incomes and what the average income can buy. Again, it's all an illusion that you think you have something, more expensive than what it actually is. Because you always hear people say, "Oh, my house is worth X." I guarantee if you were to build that house from scratch, it's worth nowhere near what you think it is. Like houses really aren't that expensive to make. But again, a lot of it's the property. But I'm saying, save for the property, the actual structure it's not that much. Definitely not what people are paying for it right now. But because of interest rates are so low, and people will buy right to the penny what they can, what they think they can afford. But anyways, so that's my rant for today. Yeah, and like I said, I'm probably going to be adding Binance soon. I haven't gotten around to it yet because I want to start getting some Cardano. But yeah, so I just think we're in an interesting place right now. Like me personally, I think this is bullish for Bitcoin, just because it looks like I said, I think that the government, the Fed, all of them, I don't think they know what to do. I really don't. Do you increase the money supply? Do you raise interest rates? Because think about it, if they do raise interest rates while all this lockdown's on, like people are going to be really screwed. No job and high interest rates. So I don't know what rabbit they're going to pull out of a hat, because I'm not going to try to, I don't have a strategy. I don't know. I don't even think they even know what they're going to do. But I'm just saying, this is a very interesting time, to say the least, because I don't know how you would combat this. I really don't. I have no idea. I'm just going to, let the quote unquote experts lead the way, because me personally, I wouldn't know what to do. I can't even be armchair quarterback on this one. people, I do this, I do that. And if they're wrong, I don't remember saying that, blah, blah, blah. I wouldn't even attempt that. Like, I wouldn't even try to armchair quarterback this one. I have no idea what you would do in this situation. But they built this situation up themselves. So anyways, so that's my rant for today, and I'll see you tomorrow.